Well, thank you everyone for joining us today. Uncovering risks in assessing the companies we work with, whether those are partners, suppliers, customers, third or nth parties down our supply chain, is a fundamental challenge facing all businesses today. And so I'm really excited that Quantexa have joined me, and in the next 45 minutes we're going to talk about uncovering risk in corporate structures, why shell companies and agents make this complicated, and why you need data and technology combined to be able to understand what risk they might pose. We'll talk about the solution and its impact, and then lastly we'll take your questions. So please type any questions you might have throughout our webinar into the questions tab, and we'll look to answer them all at the end. But first of all, let us give you an introduction to your speakers today. First off, I'm Rebecca Lee. I'm the Chief Impact Officer working with clients to use our data, particularly in the space of uncovering financial crime and other illicit activity. But my own background is in professional services, working on both the reactive and proactive side of anti-financial crime, lastly with PwC's UK Forensic Investigative Analytics Group. Alex, would you like to introduce yourself, and then Ben afterwards?
Sure, thanks, Bex. Hi, everyone. So my name's Alex Braid. I've got about 20 years in finance within tech, banking and consulting. And at Quantexa, I'm a credit risk SME within our product area, and I support client and internal projects. And recently, I've been working a lot with Ben and his team to develop new logic and features using innovative network features in a traditional risk domain. Ben.
Great, thanks, Alex. My name is Ben Houghton. I lead the analytics innovation team here at Quantexa. So we look after all of the internal data science development and research, and we use a lot of different data sources, OpenCorporates being one of our cornerstones. Prior to this, I've got 10 years experience in the world of finance and data science.
Great, thank you very much, Ben. So at the heart of process, whether that is manual or through a technology solution, is the data that's available. And that is the difficult problem OpenCorporates looks to solve, because understanding all the companies that we deal with and core facts about them is far more difficult than it should be. So OpenCorporates has worked over the last 11 years, both at the forefront of building the world's largest source of open legal identity data, but also working at the forefront of transparency, looking to ensure that information is made available from the UK at the start all the way through to the more recently Illinois, not just for people who can afford to pay for it, but for everyone who they are in business with. And our data is relied upon by governments, regulators, financial institutions, and particularly the regtech industry, who use our data to deliver those crucial insights at scale. So Alex, who are Quantexa?
Actually, Ben, would you like to?
Yeah,
you can do this one. Sorry.
Absolutely. So Quantexa is a data and analytics software company, and what we do is look at building contextual decision intelligence. So how do we do this? We have a number of capabilities, including entity resolution, where we can bring all of your different data together. We build networks through our network generation platform, so we can connect all of your data points and give you additional context through that. We also have a scoring platform where we can build risk and other scores using the data that we've generated through these capabilities. We work in a number of different spaces, including KYC, risk and compliance, customer intelligence, data management and fraud, and work with a number of huge organizations, including large banks that you can see on the left-hand side, such as HSBC and Standard Chartered, as well as insurance and telco organizations. And we're also proud to work with a number of strategic partners, including Google Cloud, Microsoft, and of course, OpenCorporates as well.
Thank you very much. So we've talked about that some of the key issues in assessing risks are shell companies and company agents, which are also known as corporate service providers, CSPs, or even trust and corporate service providers, TCSPs. Alex, why is this the case?
Well, I think shell companies are very interesting businesses, and they're quite different to a normal trading company. Often they don't have any employees, They don't trade as such. They may, though, hold material balances, so property investments or assets. And from a corporate registry perspective, when you actually look at that record, you might describe it as being thin. So it really contains very limited data versus a normal company, which has lots more information attached around directors, shareholders, financials, phone numbers, even websites. And you get quite a discrepancy in terms of how that record appears. I would say that shell companies are quite topical. They're often in the news, and we'll see that in the next slide, and they're used for many purposes, but often to hide ownership. They can create overly complex structures and be used for illegitimate purposes. Next slide, please. So just talking of the news, there's a few headlines here. If you just click through for those 3 headlines, that just highlights the focus by government and banks and even regulators on detecting shell companies and also understanding the motivation for using them. So you've seen a lot around Russian oligarchs using shell companies to hold companies, yachts, other assets, houses. Singapore and other regulators around the world are using detection of shell companies is really important to combat money laundering. And then it's quite small text, but down there in the UK, we saw working with some of the UK government actually that some of these off-the-shelf dormant companies were used to get bounce-back loans, and I've got a bit more information on that later in a couple of slides because it's been such a focus of were they used legitimately or not. And I guess, Rebecca, OpenCorporates data has been used in several of the well-known investigations into the use of shell companies. Is that right?
Yes, that's right. Quite a few, in fact, from the Panama and Pandora papers all the way through to the various laundromat investigations. I think one of the most recent ones from Transparency International, called the Partners in Crime report, found that more than 1 in 10 of all LLPs, so limited liability partnerships, ever incorporated in Britain, share almost identical characteristics with those types of shell companies to have been used in major corporation and corruption and money laundering schemes. So a huge challenge.
And so if we go onto the next slide and just look at what's been happening in the UK, this graph is describing over time how the volume of companies being created per year has increased with quite a strong upward trend over the last 20 years. And the top right, you have the last couple of years, so during the pandemic, where it accelerated even further. I think for me, the question is, why are these companies being created and by who? And then the other question is, naturally, are all companies created equally? And I think what we can see through data is that they're not. So in the UK, there's around 5 million active companies, and these incorporation rates are large. I mean, up to around 800,000 per year. And indeed, when you look at the rate per day, it's been up to around 4,000 per day or 10 per minute. And so you really do need technology to understand what's going on with these high volumes of data. When we start to look into the connected businesses, the connected companies, what we've seen and what we've heard in the past is actually in 2019, over half of all incorporations were undertaken electronically by just 106 companies, many of whom are trust and corporate service providers. And these are effectively agents, and they are professionals, and they're in the business of creating companies. So that is their job, and they'll make hundreds, thousands, tens of thousands. But their networks are quite different to the shape of a network of a normal director. And I think these TCSPs was one of the major characteristics in that Partners in Crime report that you mentioned earlier. If we go on to the next slide, then what this is describing the different types of agents, because they're not all risky, although there are different types, they're unique. And if I start from the bottom left, we have different types of shell companies created by internal users, so a CFO or a treasurer to plan for an M&A activity or structuring a business to be tax efficient. And if you work your way up into the middle left of the slide, you can see external professionals. So that is your TCSP, it's your lawyers, accountants, tax advisors, and they're creating businesses to order, and they're making businesses in bulk to put on the shelf to sell later. And there's good reasons that people may want a business like that. But as you work your way up the risk curve, the risk spectrum, you can find agents who are more opportunistic and potentially amateur. So in the past, we might have seen a lot of businesses with words like PPI reclaim and PPE. But what we're really interested in is those types, but also the fraudsters. And we've seen creation of mini umbrella companies to evade paying tax and also other types to hide ownership. But I think one of the key points here, Rebecca and Ben, is it's really hard to understand the risk profile from just a single data point. And so you really need to come at it from the corporate network perspective, where you see highly connected entities, and that might indicate the presence of an incorporation agent. And we'll see those in our data. I'll show an example in a minute with profligate directors. And I mean by that a highly connected director, a highly connected business, highly connected addresses. But the question is, does this mean in itself they are risky or not? Bex, have you got any thoughts on this?
Well, I think, as you said, the fact that you've got a lot of shell companies which exist, some for purely legitimate purposes and some from illegitimate purposes. You've got the challenge that are identifying those shells and the risk associated with their agent. And as you said, it's understanding the bigger context and the bigger picture. And that's why being able to loop out to those networks is really important.
Absolutely. So just on the final slide, if you move on one, please, we'll just sort of close off on the problem statement with a direct example. So this is a chart that I created just through some research on UK companies available for sale via agents. You could find them on websites. And what I was looking at was this discrepancy in terms of price that they're being sold at before the COVID period and also after the COVID period. And so the two axes are, you've got the shelf company sale price on the left, and they range from a few £100s to thousands of pounds the longer the life of the business. So that's the blue line along the bottom. That trends up a bit like a fine wine. The older the company is, the more it will sell for. The orange line suddenly steps up, and what's going on there is any business, or most businesses that were incorporated before the 1st of March 2020 were actually eligible to apply for a £50,000 bounce back loan. And there was very limited fraud checks and actually almost no credit checks at the time, just given the sheer volume of lending going on to support the UK economy. And that meant that suddenly any agent who had created vintage or shelf companies in the past before that date suddenly realized they were much in demand, and naturally the prices increased. And what we've seen through some of the projects we've worked on is clusters of risky agents providing these vintage or shelf companies, which eventually did get bounce back loans in some cases, and it looked like there was fraud associated. So we started to dig into that network shape, and now we're going to turn on to the sort of the solution, and Ben's going to describe a little bit more about how we approach this problem.
Absolutely, thanks very much, Alex. So we used Quantexa alongside OpenCorporates to solve this problem. The data which we used to begin with, company registry data, was at the cornerstone of this, particularly the OpenCorporates corporate registry data. And we used a number of pieces of information from this, naturally the things like the date of incorporation, but also looking at things like their directors, the addresses which companies are registered at, and even things like phone numbers. You'll see how in a second. We then use Quantexa's data fusion to bring all of this external data together, along with some other open source data sets to give some additional context, and then use entity resolution to determine who our unique entities were across these data sets. So for example, is a record ABC Limited in OpenCorporates the same as a record that might be mentioned elsewhere? We then use network generation to link all of these different entities together. So who else is registered at the address that ABC Limited is, or who else shares a directorship with the director of ABC Limited? And then we used Quantexa's advanced analytics framework to build some machine learning models using real world, i.e. Alex's expertise, to build some really useful data points which will feed into it, and then use the visualization to understand what these actually look like in real life. So moving on to the next slide, I'm going to talk a little bit more about some of the data points that we used as part of this process. Now, as I mentioned, we used data from all three of the parts of Quantexa, so both the raw data, the networks which were generated, and the entities which were created as part of that process. Some of the more simple features we used included the length of time that a company has been registered, what were they incorporated, and you can see how important that is from the chart that Alex has showed earlier. And particularly looking at companies incorporated pre and post COVID. But we can also look at more complex features such as the pattern of changes in directorship. So, for example, do we have a director who has the director of a company changed multiple times over the duration of that company, and has the director been in multiple jurisdictions, or have they also had lots of other interests outside of that company? One in particular, one really interesting feature that we found was directors resigning immediately after incorporation. And we found in particular a director resigning on the same day that a company was incorporated and handing over that directorship to someone far away, e.g. in the Philippines or Indonesia. And certainly we found that to be a fantastic indicator of risk in our networks. But not only can we use the directors and the companies as part of this model, but because we've built these networks, we can also look at the addresses and phone numbers. So is our company of interest sharing an address with other shell companies or other companies which have other risk indicators? And even things like phone number and email address, we can use this as part of our resolution to understand whether these companies could have risk factors which would be hidden in the corporate registry data alone. So using all of this information, we actually generated around 40 different features as part of this model. We used machine learning, and in particular an ensemble of machine learning models to generate a prediction for our shell companies. On the next slide, we'll just showcase a few examples of how we've used OpenCorporates along with networks to build some really useful data points. The first one, which is on the far left-hand side, is a score which we've called director homogeneity. And this looks at all of the directors of a company and compares it to their founding director. So in this example here, we can see we've got a director, the founding director in the green box, which is based in the UK. But we've also got two other directors, one based in the UK and one based in the Philippines. So we give this score 50% because 50% of the other directors are in the same jurisdiction as the founding director. And we found this to be very useful. We can see directors spreading risk across multiple jurisdictions and multiple directors. And in particular, if this director has resigned, then this is a fantastic indicator of risk. We can also look at some more complex features such as the registration numbers and how they are linked together. So you can see here, this director is incorporated for businesses. And you'll notice on the bottom that all of these registration numbers are close together, 10111, 10119, 10131. And this implies that these have been incorporated in a really short burst. So what can we glean from this? It's very likely that this director has maybe sat down over the course of an hour and just spammed out a huge number of companies over a short period of time. And hence this is a really big marker that this director could be a CSP. And then finally, we can do something similar using natural language processing to look at the similarity of the names as well across these networks. And you can see at the bottom here, SciCam and Sinca Limited, very similar names. Forza and Fonca Limited, also very similar names. And what we can do is have a look at whether the director is simply choosing, fairly garbage names out of, or potentially names out of a dictionary, and incorporating a number of companies using that same methodology. Again, giving a really good marker that this director could be a CSP or an agent. So we created a large number of such features using these networks to come up with a model which can very accurately predict whether a given company is a shell company or not. Networks are particularly useful when we've got very limited data from one source on its own, and we generally refer to this as thin file data. So let's take the business on the left-hand side, business ABC Limited. Let's imagine we've got very limited data about this business. We know its name, we know it may have 2 employees, already giving quite a good indicator that this could be a shell, and a 350k turnover. This probably isn't enough on its own to determine whether it's a shell or not. There are many legitimate business which will have this exact same profile. So in this circumstance, let's instead build a network and understand its wider context. We can see we may have, for example, its address and its director. And then if we expand out from the director on the right-hand side here, we may find that they've actually incorporated several other companies, and one of those is indeed already known to be a shell company. Similarly, we can expand out from the address and find some other high-risk organizations. So we can say that within just 2 hops from ABC Limited, we've already found other signs of risk within the network. So turning this thin file data point into something that's really rich and which can really be used for investigation purposes.
And Ben, I might just add after that explanation about sort of the traditional, which is really coming at it from like almost a document level. So you would read the corporate registry information about that business, and you'd pick out a few risk features, and you'd sort of make a judgment. What we're really doing is going from that to this shape and this extra information that is like in close proximity. And I think the reason I bring that out is when I was working with you and the team, and we were sort of feeding in targets, running the model, looking at the outputs, I actually found, using Quantexa's UI very, very sort of quick to help me decide, because I was in exactly the same position. If you gave me a business ABC Limited and I was like, well, is that a shell or not? I actually would naturally expand the network to see what is around it, and using my sort of investigative skills, although I am really a credit analyst, but looking around the network, I could say, yeah, there are multiple shells. These are having homogeneous features. This is a profligate address with multiple thousand businesses there. All things start to add up. It does look like a shell. And so I think effectively what we're doing really is applying some of the human logic into the machine and into the maths, and that's why we're getting such strong results by moving from the traditional document first approach to almost the network shape approach, which is quite innovative. And I think there were certain cases where just the network shape on its own, it sometimes doesn't even know what it's looking at in terms of the detail, but actually the shape is so informative of risk. And that's a really exciting place to be, where you can just start to look at shapes of data. It makes it very applicable, doesn't it, around the world?
Absolutely. It's all about context as well. So it's being able to bring in information from each of these different sources. And you're absolutely right about the structure as well. We haven't spoken about it here, but there are a number of different features which have gone in which look just at the shape. So not even caring about what the actual points or the nodes within the graph are, but looking at, are they connected, or are they have links which are kind of going between multiple individuals and multiple businesses. And even that, without even knowing any of these data points, can provide a lot of value to an investigation, or in this case, to a machine learning model.
I think just the final point is, I think that coming at it from a network approach is quite efficient in terms of finding risk, because what you do is you're creating a large net, and you're sort of scooping up multiple companies that are all interacting through a social network, or if you've got transaction data, it can be some other links. But effectively, when you find one, it's a bit like digging for gold, I imagine. You might find more and more and more, and it's that you start to find that these things are actually connected, and therefore, rather than just finding one shell that takes a lot of effort, you suddenly find a pocket of 1,000 shell companies through some common links, and therefore, it's from that perspective, it's quite an efficient way of looking for risk.
Absolutely. I think it's very rare that we find a director that's only incorporated one shell business, and I think that's why some of these features were so powerful, and all these different risk characteristics do tend to clump together in these networks.
So I think we might move on, Rebecca. I was going to give you a little test now, if that's okay, if we move on through the impact to these 2 networks. And I might just briefly describe to the audience what they're looking at and where this has come from. So what we have here, these are 2 screen grabs from 2 separate networks, and on the left, this has come from Quantexa's user interface. So you can see the business director entity, which are these little sort of people icons at the top left. You can see in the middle the 3 OpenCorporates documents. So this is the marrying of the data and the technology. And at the bottom left, you can see there's a business, there's also an address. So we've got quite different shapes here with pulling out directors, businesses, addresses, and things like that. And I just wanted to, given everything you've heard so far today, Rebecca, and your understanding of this space, what's your perspective on these 2 networks? Talk to me through your thought process around risk that you see here.
Well, I think I'd be a little bit embarrassed if I didn't say that the obvious risk came with the right-hand side network rather than the left-right. So you've got that director who is also a director of a ton more companies, and I imagine once you start going out from them, you're going to have the same thing again, and you're going to get into an interesting network. I think it's a bit hard to see. Some of those flags look like they aren't all in the UK. So it's got a very different look and feel to that first network, where you've got a couple of addresses that are the same. You've got kind of UK companies with a couple of similar addresses. So I'd certainly say the one on the right had more risk, and as you go through it, you're likely to find more things to look at.
So you're absolutely right, which is great. Yeah, they are very different networks. The one on the left is it's a UK business. It's a family-owned business. The business names are similar but not unusual, and so we've seen some strange named businesses that Ben took us through. You've also got this address at the bottom, which is not a highly connected address. It's not a profligate address, so this looks quite legitimate. Some of these directors are only connected to these businesses or to a couple of businesses. The one on the sort of the top right with 4 sort of documents attached, they have some other experience, and again that is good to know, because really when you're starting a banking relationship with a business or lending money or doing KYC, it's quite good to have directors with experience, so that can be quite a positive one. Switching to the network on the right, it's a sort of a story of 2 halves here almost. So the central person is the agent in the center of the star. They've created those 10 or 12 businesses around them, the OpenCorporates documents. But then if you step out to the furthest directors, they have become the 100% shareholder and the new director, but they are all offshore in this case. So that's where Ben's features work nicely, but they are also almost not connected to anyone else. So these are effectively front directors. They've been found through social media, through Facebook, Snapchat, some other social platform, paid a small amount of money. And this is some example networks from mini umbrella company fraud that we've seen, and we've sort of like validated with various people when we look through them. So I mean, when I look at this, it's a very, very different shape, as you rightly pointed out. And I think, applying technology, you can start to pull out this like intelligence of the shape. And so yeah, I think this is the kind of the beauty of the data and the tech coming together, and applying it to like a real world problem that is highly relevant today.
Yeah, and I think the visual aspect of it is really important. Certainly when I've been investigating other companies, when we used to do it manually, you kind of draw it out because that's how you made sense, and you tried to traverse different directors and different companies on a one-by-one basis, bringing it all together in not just a visual, but also giving you that scoring mechanism so you can do it at scale is so important.
And I remember we were discussing just last week about like how do people actually use this, because I think it's great to see a UI, but it's like, how do you feed it into a process? Ben, do you want to just take that in terms of like how Quantexa works with providing this information, and specifically this shell detection model that you've created?
Absolutely. So there's a number of ways that this can be used. I think the most common one is to incorporate this into a scorecard. So you can see this particular risk incorporated with all of the other risks that you may be monitoring within your investigations. But also just knowing where to start looking for these shell companies. As Alex said, you can start using the UI to find other shell companies situated around it. So even in a less automated way, having this information as part of a manual investigation can be incredibly useful. And of course, I can't really sit here and not start talking about machine learning as well. But we find all of these things are incredibly useful when you're building models to try and find more holistic risk across very, very large networks and data sets.
I think just one other point for me on sort of using this. So I come at it from more of a credit risk, so lending money perspective rather than the AML or KYC perspective. And when I think about these networks and these shell companies, and specifically the agents, and understanding are they a risky agent, I'm always looking for early warnings, any early warning signal that this company is going to end up defaulting, not paying its loans, Phoenix operations. Finding risky agents who create risky companies basically gives me a day zero or a day one early warning flag. I mean, you can't get earlier than that. They've created a business, and I already have a suspicion that that is going to become a bad business from the day it's created. So when they come to the bank and they say, I'd like an overdraft or a loan, already I've got a sense that there's heightened risk here. And I think that is like a phenomenal way of using machine learning models to create that sort of predictivity of risk and bringing it all the way back to the start point.
Yeah. I think the word that Ben said that I thought was really important was scorecard. Actually, having been in implementations where, particularly when we started implementing transaction monitoring, we had a set of rules based, you can very easily kind of situation where you've just got so many alerts and so many risky things and red flags to look at, and boiling it down to a scorecard where you've got all of those risks and you can prioritize the highest ones and the ones you look at that, whether that's in perpetual KYC or kind of your investigations, I think is one of the most important parts of the process.
So I just do you want to go on to the next slide just in terms of bringing this impact through as well? Just click through, thank you. So I guess just in terms of like wrapping up, we've talked through the problem, we've talked through the data that's available, we've talked through the technology and the methodology, and I think what we've seen is, look, there is a need to detect shell companies. We see it in the press a lot. You can see 3 examples just here, and understanding the shell companies as well as those creating them and the risk profile of the agents is just becoming like a given, a need. Like, we need to understand this better for better risk management. When we think about the volumes of companies being incorporated, you can see that's just trending up, and it's not just in the UK, it's around the world, especially during the pandemic with all that government money coming out at such a rate that in the US, in the UK and other geographies around the world, companies were being set up to take advantage of that, and some of it, fraudulently, unfortunately. And coming at this from a network perspective, obviously this takes motivated individuals, and they'll work in groups and they will reuse data points such as addresses, phone numbers, and therefore that's where the network comes through. So it really does make a lot of sense to use like new technology, network analytics, and really strong quality data to be able to assess risk. And so even just beyond today's interest from a sanctions perspective, you can see a real economic cost to governments and banks from sort of tax dodging. There's a financial cost for companies that might misrecognize a business that looks legitimate, but actually shell companies proximate to it. And then there's also the reputational impact as well, and no one wants to be caught dealing with lots of shell businesses. And so I think what we're finding at Quantexa is just a huge demand for this type of product and solution that all around the world, and in different with different clients.
Great, thank you so much. That's the end of the bit that we're presenting on this webinar today. So we'll go over now to some of the questions that have been coming in, and thank you very much for your set of questions. Let me go straight into the first one. You've talked about this in terms of the UK. How does this work in other geographies where there is less corporate data available? Ben, do you want to take this one?
Absolutely. So you're absolutely right. I mean, every single geography is going to have a very different set of requirements on what they record, and particularly when it comes to incorporation data, that there will be certain blind spots that we're going to have just by the way that companies are recorded. One of the beauties of working with network data is that a lot of these shapes can still be retained. So yes, you may not know the turnover, you may not know the assets, But what you probably will know is some of the directors and potentially an address or some other information like this. So this means that even though you can't build a massive profile just of that company, you can really build their network and get all of that great context. So I think there's even state by state in the US, there are some particular states where you wouldn't necessarily see as much information as you would in some. But because you can still link those companies to the states where you may see lots of information, you are able to start building a much more full picture. And going back to Alex's example earlier, this can be particularly useful in the world of credit risk, where you're maybe incorporating a new organization in, let's say, a state with very little information, and you've got very little information to go on from the outset. But as soon as you can start building that network, you'll have those initial early warning indicators that you can use.
Great, fantastic. So the next one is, do you consider addresses as one of the factors to identify potential tax havens and shell companies associated with them?
Yeah, I can maybe start on this one. So yes, jurisdiction is particularly important. So obviously, without naming any particular countries, I'm sure most people on this webinar will know a couple of hotspots for some of these kinds of activities. And then you can then propagate out from that. You can understand, how far are you away from some of these jurisdictions? Do you share director with someone who works in a lot of these jurisdictions, or do you have addresses? Maybe not your primary address, but other addresses based in some of these geographies. And there are some really novel things that you can do in addition to this. If you've got things like Street View for particularly some of these organizations, you may be able to use that to determine, is this large company being incorporated at what looks like a residential address? Again, another sign that there could be a risk of some sort associated with it. Don't know, Alex, anything to add on in the world of addresses?
Yeah, I think sometimes people fake addresses, and so actually entity resolution is really important. And we see businesses almost slicing up a building into multiple flats, and those flats don't actually exist. So it might be a small house, but somehow it's got sort of 500 flats within it. And so entity resolution is effectively looking at the components of that address and saying, well, all of those actually resolve to one building, and a bit like your example with the Street View, or maybe even the indicative property price, you can start to get a sense of something looks a bit off here. So I think that's one point I'd say. The other is enriching data with other data types, so whether it's Transparency International and low tax jurisdiction information. I mean, there are rankings of areas around the world which are sort of extremely favorable for low tax, and I think when you start to see networks that end up there or have a high proportion of the network ending up in that area, or almost sort of disappearing, they like vapor, they sort of disappear, and suddenly you lose information because there's nominee directors and things like that. That's just adding more risk elements, and so you can apply all of this as features, as kind of indicative features of shell companies, and say, well, it's looking like a shell now because of X, Y, and Z.
Yeah. And actually, you talked about entity resolution. We've got a question on that as well. How can you be sure that the directors in different corporate listings are the same person and not just similarly named people? And taking it from us, there are very few jurisdictions that actually have a director ID, so that you can be absolutely sure, or as far as you can from the register's point of view, that this is an individual as opposed to two individuals with the same name. What's your point of view in terms of your technology and how it addresses that?
It's a fantastic question. So you're absolutely right. There's certainly kind of similar names, like let's say John Smith, for instance. It can be very difficult. So you've got to try and find lots of other data points which you can use to combine with the name. So things like date of birth. Two John Smiths with the same date of birth, it makes it immediately less likely that they might be more likely that they might be the same person. And then when you start including, again, it all comes down to context. When you start including addresses, businesses, and all of these other pieces of information, you start building a much more bigger picture around John Smith. And for different use cases, you may have very different requirements. So it may be for some use cases absolutely imperative that we don't get these directors mixed up. And for another use case, it may be imperative that doesn't matter too much about John Smith, but his business, we need to be absolutely sure that we're only talking about one particular organization. So you'll need to adjust all of these levers for each of the different use cases that you're looking at, which is something that Quantexa can do as part of its end-to-end entity resolution platform.
Yeah, it's a really important piece, particularly as you see in the Panama Papers and others, where you've got a director using slightly different middle initials, or even changing the way that their name is written to try and identify themselves as a different person. In terms of the next question, is the shell issue specifically a UK and Companies House issue, or have we seen this in other countries such as the Netherlands? I would say that from our work with journalists and others, this is absolutely not a UK issue. The fact that because the UK has so much openly available data, I mean, we complain about it all the time. We're working on the Economic Crime and Corporate Transparency Bill with others. There is a huge amount of information that's available openly and publicly from Companies House, which just isn't the same in other countries. But we see the same risks, the same shell companies being created, particularly obviously where registers are not showing their data in the tax havens and others. There are better controls in other countries where we're seeing verification come into place. But again, those are far and few between, and that's also something that is looking to come in the Economic Crime and Corporate Transparency Bill, although we're actually quite concerned about the fact that TCSPs are going to be able to verify those individuals and then not at the moment pass documentation about the verification back to Companies House. Alex, Ben, what's your view on that? Do you have any difference in opinion?
No, I think that's fair. I don't know, Ben, anything else to add?
We definitely see shells in pretty much every single jurisdiction. I think what changes is the ability to detect them. So where you've got blind spots, or where you've got changes in how companies incorporated, it can be very difficult to gather enough information to find them. As Rebecca rightly pointed out, we're quite lucky in the UK that with OpenCorporates and with Companies House and with a lot of really good open data, we can build these full pictures. And we've found tens of thousands of shell companies in the UK. But in somewhere, I think a really good example is South Africa. It's particularly difficult, not because there aren't these shell companies existing, but because the available data in the open space is more challenging.
Absolutely.
Just one point I might to that. Thanks, Ben. Sorry, is just around how do we go about finding like examples? Because in machine learning, you often want targets, and so actually a lot of these agents, they have websites, they have lists of available shell companies for sale, and you can find them on these global data sets like OpenCorporates. And so effectively you can start to like tag real shell companies with a price if you can get that information. And then a bit like analysts and investigators use, there's the Wayback Machine, if people are aware of that. So you can effectively go back in time and say, okay, I can see what you got for sale today, but what did you have for sale 6 months ago? And you get another list of companies available for sale. And that's one of the ways that I was able to work and support Ben's team, by effectively scraping a bit of some of this information and finding it. And you can do that in the UK, but also other jurisdictions around the world. And then you start to see slight variations in the data, in the patterns, and then you can build a more accurate model by just tweaking it slightly to say, well, in Cyprus it looks a bit like this, and in Australia it looks a bit like that, and then that really helps our customers sort of have a more accurate model. I think in the UK, though, just coming back to your original point, the fact that it's quite cheap to create a business means there's not much friction, and therefore that's probably why you get such a huge amount being created. I think people have discussed about putting the price up. That would probably mean less shell companies, but at the moment we are where we are.
Yeah, absolutely. So we are at time for our 45-minute presentation today. There are a couple of questions that we have not been able to cover. We will get in contact with you and provide you answers on those questions. Otherwise, thank you very much for joining us. Thank you again to Alex and Ben for joining us, me today and talking through Quantexa's solution here and the problems that we see. You'll receive a recording of the webinar by email over the next couple of days, and please do complete the post-webinar survey that should appear, I believe, after you close the webinar system. Your feedback helps us make the next webinars even better. So thank you again. Have a good rest of your day.
Thanks very much.
Thanks, everybody.